And we're just starting to see that uptick. Like we said earlier, the SOM rule has been triggered. And all of these, and I'm just mentioning, this is just the tip of the iceberg. If you want to go and look at all the data, it almost all lines up the exact same way it did in the beginning of 2008. Now, if the curve was not inverted, if the SOM rule was not triggered, if unemployment wasn't, and the way unemployment works is just like bankruptcy. It's very, very slowly, then all at once. And it happens that way in every single cycle.
George Gammon is warning of a major storm that is about to hit the market. A major recession worth $10 trillion is about to hit the U.S. economy. All market indicators point to a major crisis coming. Now listen to what George has to say.
This time, it's not different. It's never different. It's just that's always the narrative leading up to the stuff hitting the fan. So when the SOM rule is triggered, we are either in a recession or very, very, very close to a recession. It's got a 100% accuracy going back to the 1950s. That's why the curve uninverts, because look, the curve isn't magic. It's just a representation of what market participants are doing. In my opinion, it's just a matter of when. It's not really a matter of if.
Another big sign that things are going badly is government spending. In recent months, it has been increasing and creating a huge snowball effect that is becoming harder to stop every day. The government is approaching a critical point where it may actually run out of resources. Every 100 days, the US adds another $1 trillion to the national debt, and the situation is only getting worse.
It means that the economy is collapsing, that the economy is going through some very, very difficult periods, which even if they lower rates, isn't going to move the needle. Let's be very clear about government spending, especially in the long run. It is by no means stimulus. It's a sedative. It creates economic distortions that slow down the economy. I mean, think about what you're saying. You're saying that if the government spending is a higher percentage of GDP, then somehow that's a good thing, that's going to make the economy boom and reaccelerate. What? That's exactly what I'm saying. That's it. That's what the yield curve is telling you, that the insiders, the financial insiders, would much prefer to own a 10-year treasury, or I'm just using that as a proxy for long end of the curve, because they want the juice, right? They want the juice that they're going to get from duration. And to tell you how extreme this is, just today, the 2-year treasury is down almost 30 basis points. 30. And keep in mind, this is after the market has had the opportunity to digest and price in everything that Powell said on Wednesday. So the 10-year treasury, as you would expect, is down as well, but it's only down 17 basis points. So what does that tell you? That tells you that the 2-year treasury is going down at a much faster pace than the 10-year, i.e. a bull steepener. The exact same thing that we have seen play out in every single cycle going back to the 1950s.
This is a ticking time bomb that is becoming increasingly critical. We are living in a time when 30% of the federal budget is financed through debt. In fact, much of this debt is being created to pay off previous debts, and this creates a dangerous cycle that seems to have no end out. Programs like Social Security, which were implemented at a time when life expectancy was about 64, now have to support a population that lives into its late 80s, which means that per capita costs have increased significantly. Today, Social Security is the largest expense of the U.S. government, consuming 22% of the federal budget, and this program will need to be revamped or terminated within the next 10 years.
What I'm saying is that this is a signal that is becoming more powerful. But when you know that you've crossed that line in the sand, is not when the curve is uninverting, but when the curve is uninverted and stays uninverted for a sustained period of time. I'm from the simple standpoint, there's nothing else recessionary that I can see. Well, how about the fact that the 10-year treasury is trading at we're trading at 3.8, let's say. So we're 150 basis points under Fed funds. How is that not the most bearish signal of all time? Do you say the bond market is always wrong? No, it's not. Now, if you want to sit there and say the bond market is wrong because inflation exceeds the rate of interest that you're getting on that treasury that you're holding, okay, there's kind of an argument there. Obviously, if your expenses are denominated in dollars. But what I'm talking about is the bond market always being right is in future growth and inflation expectations. That's where the bond market is always right. And you go back to these inversions, it's never been wrong. And we're just starting to see that uptick. Like we said earlier, the SOM rule has been triggered, and all of these, and I'm just mentioning, this is just the tip of the iceberg. If you want to go and look at all the data, it almost all lines up the exact same way it did in the beginning of 2008.
One of the biggest signs that a recession is coming is government bonds. An inverted yield curve occurs when the interest rate on short-term U.S. Treasury notes exceeds that on long-term Treasury bonds. Typically, long-term bonds have higher yields than short-term bonds because of the higher risk over a longer period of time. However, during times of economic uncertainty, investors prefer the safety of long-term bonds, leading to higher demand and lower yields on these bonds compared to short-term bonds. Now, all of this is a big red flag that indicates that investors and the entire market are experiencing great uncertainty regarding the future of the U.S. economy.
And going back to the Somme rule, going back to the uninversion of the curve, going back to the 1950s, not only has the inversion preceded every single recession, but the uninversion that we see every single time is a bull steepener. It's a bull steepener. And I mean, you see this all the time. You're in markets. You have heard the narrative for the last 6 months. Oh, the yield curve is dead. Don't look at the long-term interest rates. They don't matter anymore. And you've heard every excuse under the sun as to why this time it's different. Oh, this time it's different because the Treasury is going to issue so much debt because of the deficits and the debt that the long end of the curve is going to go up and we're going to have a bear steepener. Or, oh, we've got reflation because of China, because of India. I mean, you throw in the excuse as to why this time it's different. But this time it's never different. It's never different this time. And the market is waking up to the fact that, oh, wait a minute, lower interest rates aren't necessarily stimulus. Oh, wait, lower interest rates aren't actually a good thing. They're a bad thing. They're a bad thing because the reason we have lower interest rates, the reason the Fed is going to raise rates isn't because we're getting a no landing or a soft landing, and they're just magically bringing the inflation rate down to their 2% target while the economy is booming. So the curve inverts before we get a recession. This has happened every single time going back to the 1950s, where the inverted yield curve has preceded every single recession hard landing we have had. But the hard landing of the recession very rarely happens when the curve is inverted. It's when the curve uninverts. And it's very important to distinguish between the two ways the curve can uninvert. Number one, you've got a bear steepener, and I'll explain this in a moment. And number two, you've got a bull steepener.
Another major factor that is worsening the economic situation and bringing us closer to a recession is the massive growth of aggregate M2. The US, like many other countries, appears to be adopting modern monetary theory, essentially printing money without the same concern for debt. This is alarming because if you look at history, you see that one of the hallmarks of a declining empire is exactly that, not paying off its debts and increasing the money supply. Rome, for example, tried something similar when it adopted an early version of modern monetary theory near the end of its empire, while at the same time accumulating massive debts. However, modern economists believe that this time around, things will be different for a number of reasons. But if history teaches us anything, it is that debt always wins, and the entire system could collapse if we do not take corrective action soon.
If the economy was doing so well, you wouldn't have bank credit flat. You wouldn't show me the time when M2 money supply has gone down over a 2-year period and we haven't been in not a recession but a Great Depression.
These are just the fears of a recession, but there are other strange things happening right now that could become major concerns in the future. One example is the volatility of the stock market. It recently reached such a high that it was only surpassed when the pandemic began and the economy was virtually shut down. This increase in volatility is an alarming sign that investors are extremely uncertain about the future of the stock market in the short term, and that is a major concern that investors have today. It is that, at some point, the American economy will no longer be able to sustain these massive deficits year after year, and that is why there is great fear about what will happen to the American empire and everything that resides in it.
Look, my base case is absolutely, we will see an inflationary decade in 2020s. But it's always a roller coaster ride. And I don't think it's going to be like the 1970s. I think it's going to be like the 1940s from the standpoint where you have these huge swings between consumer price inflation, disinflation, and then outright deflation. I mean, I was just looking at a chart when you were speaking there, and going into 2008, the CPI, and I don't know if this chart is too accurate, so you'll have to fact check me on this, but the CPI was higher than it is today. And then, as you guys know, in 2009, we actually got a quarter, I think it was Q2 or maybe Q3, of outright deflation.
It has been reported that US companies are no longer hiring at the same rate as initially expected, with ZipRecruiter's chief economist saying the job market is clearly no longer normalizing. Another sign of an impending recession is unemployment in the US. Further deterioration could trigger a negative cycle of job losses, declines in consumer spending, declines in business revenue, and more job cuts. Looking at the indicators, we can see that unemployment continues to rise and job creation continues to fall. In fact, the unemployment rate is the highest it has been since the pandemic began. This is a fact that if it continues to rise steadily, a recession almost always follows, and that seems to be something that is happening right now in the United States. Since the 1950s, it has correctly predicted almost every recession we have seen. In this case, if the 3-month moving average of the unemployment rate rises by 0.5 percentage point from the previous year, a recession is imminent or already underway. You can see where I am going with this.